All right, today we're going to break down a trading strategy that's not only simple and reliable, but it works across pretty much any market you can think of. We're talking stocks, crypto, Forex, you name it. Let's get into it. If you're a trader, you've been there. You're hunting for a system that isn't crazy complicated, but is still sharp enough to give you a genuine edge. It's a huge challenge, for sure. But there are some proven methods out there that really cut through all the noise. And this strategy is one of them. It's a really simple, visual, and honestly powerful tool for spotting potential shifts in market trends. So let's just dive right in and start with its foundation. To really master the crossover strategy, you first have to get comfortable with its most important piece, the moving average itself. Think of it as the engine that drives every single signal we're about to talk about. So what exactly is a moving average? Well, simply put, it just calculates the average price of something over a set amount of time. Its whole job is to smooth out all that choppy day-to-day price noise so you can get a much clearer picture of the real trend underneath. Now, this strategy relies on how two different kinds of moving averages play together. You've got your fast one, which is like your action line. It reacts really quickly to what's happening right now. Then you have the slow one, which is your baseline. It shows you the bigger, more established trend. The magic really happens when these two lines interact. Okay, let's get to our first big signal, the one that tells you there might be some upward momentum coming. This is what traders call the golden cross, and it's your cue to start paying very close attention. Yeah, the golden cross is a classic bullish signal. It's basically the chart's way of telling you that short-term momentum is starting to win the fight, and it could be the very beginning of a new uptrend. And the mechanics of it? Incredibly simple. All you do is watch your two moving average lines. When that fast action line crosses decisively above the slow baseline trend line, boom, that's your buy signal. That's the golden cross. Now for the other side of the coin. Every good strategy needs an exit plan, right? Or at least a way to spot when things might be turning sour. For this strategy, that signal has a pretty dramatic name, the death cross. So just like the golden cross hints at an uptrend, the death cross is your warning bell. It suggests that momentum is shifting to the downside and that the bears might be about to take over. And the logic here is the perfect mirror image of the buy signal. You're watching the exact same two lines, but this time you're looking for that fast action line to cross below the slow baseline trend. When you see that happen, it's a potential signal that a downtrend is starting. Okay, so we've covered the theory behind the signals. But theory is pretty useless if you can't apply it, right? So this section is the playbook. It's how you actually set this strategy up and execute trades based on what the chart is telling you. Now, this is really important. This strategy is not a one-size-fits-all deal. The settings you use have to match your trading style. So an intraday trader looking for quick signals might use a zippy 9 and 21 MA combo, but a long-term investor, they'd be using the classic 50 and 200-day moving averages to spot those huge major trend changes. So let's walk through it. First, you spot that golden cross on the chart. Second, you enter your long position. But the third step is arguably the most critical. You have to manage your risk. You immediately place your stop loss just below the most recent dip in the price chart, what's called the swing low. This is your safety net in case this signal turns out to be a fake out. And executing a sell trade? It's the exact opposite. Step 1, you identify the death cross. Step 2, you enter a short position. And step 3, you manage that risk by placing a stop loss just above the recent peak in the price, or the swing high. See? The logic is perfectly symmetrical. Now, let's be real. No strategy is perfect. The thing that separates a good trader from a great one is knowing the weaknesses of their tools and, more importantly, knowing how to compensate for them. So let's talk about how to make this strategy even stronger. Every system has an Achilles heel, a specific environment where it just doesn't work that well. So for a trend-following strategy like this one, what do you think that environment might be? You got it. It's a market that isn't trending at all. In a sideways or ranging market, the price is just kind of bouncing around between two levels. When that happens, the moving averages get all tangled up and they'll crisscross constantly, generating the storm of confusing false signals. This is exactly where you can get into trouble. So how do you protect yourself from that? Simple. You never, ever rely on the crossover alone. A strong, real move is almost always backed by a big spike in trading volume. You can also confirm the signal by checking if the price has broken a major trend line or if another indicator you trust, maybe something like the RSI, is telling you the same story. Confirmation is absolutely key.
And there you have it, the components, the signals, the execution plan, and the safety measures. It's a complete playbook for the moving average crossover strategy. So the only question left is, now that you know how it all works, where are you going to apply it first?